Look at almost anything you buy, and part of the price is tax. Petrol, a chocolate bar, a plane ticket. Governments do not set these prices directly. Instead, they shift the supply curve, and the market does the rest. In this video, we take the demand and supply diagram and put an indirect tax on it, then a subsidy, and then answer the question examiners really care about. When a tax is added, who actually ends up paying it? Quick recap of the diagram we built last time. Price is on the vertical axis, quantity on the horizontal. Demand slopes down, supply slopes up, and where they cross is the equilibrium, price P1 and quantity Q1. Left alone, the market clears here. Now we let the government step in and change things. Why would a government interfere with a market that clears on its own? 3 main reasons. To raise revenue, because taxes on spending bring in money. To discourage things that are bad for us or for other people, like cigarettes, alcohol, or pollution. And to encourage things that are good for us, like public transport, vaccines, or renewable energy. Taxes push consumption down, subsidies push it up, and both work by moving the supply curve. Start with an indirect tax. It is a tax on spending, charged on the good itself, and collected from the seller rather than paid straight to the government by you. There are 2 types. A specific tax is a fixed amount per unit, like a set number of pence on every litre of fuel. An ad valorem tax is a percentage of the price, and value-added tax at 20% is the everyday example. We will draw the specific tax first, because it is the cleaner picture. A tax adds to the cost of supplying every unit, so sellers need a higher price to offer the same quantity. That shifts the supply curve upwards, from S1 to S2. For a specific tax, the shift is parallel, because the same amount is added at every quantity. The key thing to see is the vertical gap between the 2 curves. That distance is the tax per unit. Demand has not moved. Buyers have not changed. It is the seller's costs that have gone up. Now follow the diagram to the new equilibrium, where demand meets the new supply curve. S2. The price rises from P1 to P2, and the quantity falls from Q1 to Q2. So the tax does what the government wanted. It raises the price and reduces how much is bought. But notice the price has not risen by the full amount of the tax. It has gone up by less, and that gap is the whole story of who pays. Here is the idea examiners love, called the incidence of the tax, meaning who actually bears it. The seller hands the money to the government, but they pass part of it on. Consumers pay more. The rise from P1 up to P2 is the consumer's share. Producers receive less. After handing over the tax, they are left with the price down at P3, so the fall from P1 to P3 is the producer's share. The full gap from P3 to P2 is the tax per unit, and that gap multiplied by the new quantity Q2 is the government's total tax revenue, the shaded box. How that burden splits between consumer and producer depends on price elasticity of demand. On the left, demand is inelastic, a steep curve, because there are few substitutes. Buyers cannot easily cut back, so they swallow most of the tax and the consumer's share is large. On the right, demand is elastic, a flat curve. Buyers walk away if the price rises, so producers have to absorb most of the tax, and the producer's share is large. This is exactly why so-called sin taxes target inelastic goods like cigarettes, fuel and alcohol. Consumption barely falls, so the revenue stays high. Back to the 2 types for a moment. An ad valorem tax is a percentage, so it takes more in cash terms when the price is higher. That means the new supply curve does not stay parallel. It pivots away from the old one, and the gap between them widens as you go up the diagram. A specific tax gives you parallel lines. An ad valorem tax gives you a widening wedge. Everything else about the analysis, the higher price, the lower quantity, and the incidence, works in exactly the same way. Now the mirror image. A subsidy. This is a payment from the government to producers for each unit they make, designed to lower the price and raise output. Governments use subsidies for things they want more of, like renewable energy, farming, public transport, and vaccines. Where a tax adds to costs, a subsidy takes them away, so everything we just did now runs in reverse. A subsidy lowers the effective cost of supplying each unit, so sellers will offer the same quantity for a lower price. The supply curve shifts downwards from S1 to S2, and the vertical gap between them is the subsidy per unit. Demand again stays exactly where it is. It is the supply side that the government has changed. Follow it to the new equilibrium. The price falls from P1 to P2, and the quantity rises from Q1 to Q2. Consumers pay less and more is bought, which is the point. The government wanted more of this good produced and consumed. Just as with the tax, the price does not fall by the full subsidy. It falls by less, because part of the subsidy is kept by producers. A subsidy is not free. It costs the government the subsidy per unit multiplied by the new quantity, which is the shaded box, and that money comes from taxpayers. The benefit splits, again according to elasticity. Consumers gain the fall in the price they now pay. Producers gain because the price they actually receive, once you add the subsidy on top, is higher than before. So both sides share the gain, and how it splits depends on elasticity in the same way as the tax. In the exam, these diagrams score quickly if you are precise. Draw the shift and label it clearly, S1 to S2. Mark the tax or the subsidy as the vertical gap between the two curves, not as a movement along one. Show both the old and the new equilibrium, and shade the revenue box for a tax or the cost box for a subsidy. Then state plainly what happened to price and to quantity. Label everything, and the marks follow. A few things to keep sharp. First, a tax or a subsidy shifts the supply curve, not the demand curve. Buyers have not changed, the seller's costs have. Second, do not say the price rises by the full tax. It only would if demand were perfectly inelastic, and the split depends on elasticity. Third, remember a government can have competing aims. A tobacco tax raises revenue, but is meant to cut smoking, and if it succeeds in cutting smoking, the revenue falls. And as always, hold other things equal and name the real cause. 3 things to take away. 1. An indirect tax shifts supply up, raising the price and lowering the quantity, while a subsidy shifts supply down, lowering the price and raising the quantity. 2. The vertical gap between the two supply curves is the tax or the subsidy per unit, and that gap times the new quantity is the government's revenue or its cost. 3. Who bears a tax or gains from a subsidy depends on price elasticity of demand. The more inelastic the demand, the more the consumer bears. If that made taxes and subsidies click, subscribe for the rest of the AQA spec, 1 point at a time. Next up, we stay with this same diagram and look at price controls when the government sets a maximum or a minimum price and the shortages and surpluses that follow. Drop any questions in the comments.